This is Robert Kraft, and I'm your host for the SNN Network virtual conference. Thank you all for joining us today and for tuning in for this panel, which is our COVID-19 impact. What's next from an accounting perspective? So back in April, we did a similar panel. So we figured it was time to get most of the crew and a few new faces back together to really talk about what's happened since. So with that, and also I'd love to thank all of our sponsors for this panel. That includes Friedman LLP, Marcum LLP, Malone, Bailey, Weinberg and Company, as well as SingerLewak. So with that, I'd like to throw it to Neil Levine, who is our moderator for this panel. And Neil, take it away, man.
Hey, thanks, Robert. Good afternoon, everyone, and welcome to the SNN Network virtual conference and the accounting panel, COVID-19, what's next from an accounting perspective. I'm honored once again to be the moderator of the panel, and we're the lead sponsor, Friedman LLP, for this great event. First off, I would like to introduce you to my esteemed colleagues who I've been fortunate to discuss the current events that are happening as it relates to COVID-19. Then I'm going to give each of our panelists a minute or so to tell them about themselves, tell you about themselves and the special areas of service and their firms. So I'll just introduce first, then I'll talk about me, then you guys could go ahead. So we have Corey Fischer from Weinberg and Company. Hello, Corey, how are you?
Morning, Neil.
Great. David Grossman from Marcum LLP. Nice to see you, David.
Good to see you, Neil.
Great. We've got Stephen Vertucci from Malone Bailey.
Good morning, Neil.
Morning. And Ed Schenkein from SingerLewak LLP. Hi, Eddie. Okay.
Hello,
Ed.
everyone.
Great to see you, Ed. So again, I'm Neil Levine. I'm the co-leader of the Friedman SEC practice since 2004. Friedman is a firm of over 500 employees, formed in 1924, almost 100 years ago. Our SEC practice has grown to number 12 in the country. And with the amount of registrants that we audit, and I always like to say we're a very good alternative to the top 11 firms. We handle companies on all the major exchanges and the OTC markets. We have a large international presence, putting us number 4 in the rankings in bringing companies from China and trading on the national exchanges here. We're also part of a large international body called DFK, where our managing partner sits as the deputy commissioner there. So we really are in charge of that international body. With that being said, I'm going to turn it over to our panelists who I've had the pleasure of hosting. This might be my 7th or 8th year. And I'll throw it over right now to Corey. Corey, I'm going to go on mute and you go ahead.
Thanks, Neil. My name is Corey Fischer. I am the managing partner for Weinberg and Company CPAs. We're located in Los Angeles and California, as well as we have offices in Florida. Our firm specializes really in auditing small cap companies. We've been doing it for a long time. As follow up to Neil, I'd say that we're a good alternative to the top 12 firms. We've been doing this for a while. I previously was with one of the large Big Four firms, and then I became a CFO for a couple of highly traded public company. So got a good mixture of both public and private experience. Been on these panels many times with most of these panelists and look forward to a good conference.
Thanks, Corey. And now I'll throw it over to David Grossman. Hi, David.
Hello, Neil, again. Thanks. I am David Grossman. As Neil mentioned, I am the partner in charge of the assurance practice for the Houston office of Marcum. little bit of background about me. I started my career with one of the big four, then was in industry as a CFO and other executive roles for several years, and then got back into public accounting in 2005. Marcum is one of the largest independent public accounting and advisory service firms in the country. We have 31 offices in major business markets throughout the U.S., as well as a few offices internationally. We're headquartered in New York City. Marcum provides a spectrum of traditional tax, assurance, accounting, along with advisory, valuation, and lit support. We serve both privately held and publicly registered companies, as well as private equity funds and hedge funds. Our primary focus is on the middle cap market companies and closely held businesses. And we currently serve as the auditor for about 200 public companies. Back to you, Neil.
Thank you so much. And we also have Stephen Vertucci from Malone and Bailey. Stephen, go ahead.
Thanks, Neil. Hi, my name is Stephen Vertucci. I'm an audit partner with Malone Bailey. I've been with Malone Bailey around 21 years, 13 of those years as a partner, with most of my time in those 21 years spent working with public companies. We are headquartered in Houston. We are a full-service CPA firm. We do have a specialty working with public companies that are going public, as well as those that are already public, looking to maintain their public status. We also work with our clients on their major financings, as well as their uplistings to higher exchanges. We do have 2 offices in China, one in Beijing, one in Shenzhen. Those offices serve Asian-based companies that are publicly traded here in the U.S. We have a tax and consulting practice that works with both public and private companies, as well as an audit review and compilation practice for those companies that are privately held. We are part of Nexia International, which is a global network of independent accounting and consulting firms, which helps expand our reach both nationally and internationally.
Great, thank you, Stephen. And now we'll throw it over to Ed Schenkein. Nice to see you, Eddie.
Thanks, Neil. So I'm the Denver office lead partner of SingerLewak. We have offices here in Colorado, Northern and Southern California, Las Vegas. So we're a Western regional firm. We're a 60-year-old firm, top 60 firm in the country. We do both public and private company work. So we do assist people in the IPO process from the small cap all the way NASDAQ on up through NYSE, the full SOX reporting, etc. So in addition to the traditional audit and review services that we provide to public companies, we also do tax provision work. We can do state and local tax work, a lot of various forms of advisory work within all the specialty lines, that from informatics to systems and whatnot. So that's kind of our story. Back to you, Neil.
Hey, thanks so much, guys. So with that, again, welcome everyone. Let's have a lively, friendly discussion. So the last time we met, we were just talking about a month into this COVID-19 pandemic. And my first question, I'm going to throw over to Corey Fischer. Corey, is there any new guidance to account for the PPP loans, and what might we expect, especially next week, regarding the new stimulus package that may or may not come? And with that, after you answer that, I'd like to know with the group, there was a big uproar with some of the public companies that did take the PPP loans. And after that, how are these loans treated or will be treated after potential forgiveness? So, Corey, take it away.
Yeah, thank you, Neil. Forward looking, the House and the Senate are still working on their bill. Don't really know if there's going to be, don't have a crystal ball on what sort of stimulus will be coming down to the small businesses. There apparently will be some, but I think it's going to be more targeted to the small mom and pops. As you mentioned, there was a lot of, with the first round of PPP funding, a lot of public companies did participate in that. There was a lot of pushback in the press, social media. So it's going to, not sure how it's going to play out. There still are PPP funds, I believe, available till the end of next week under the old rule. But it's interesting. It's going to be interesting to see what the companies that did receive these funds do with the money, the public companies. There's a lot of pushback because, companies were receiving PPP funds and at the same time were in the equity markets, selling securities. So it'll be interesting to see what happens. I've seen a number of public companies simultaneously raise equity with the receipt of these funds. So payback periods start soon. Interesting to see what happens. The accounting, the AICPA did put out I guess was in a question and answer, some guidance on how to account for these loans. Nothing really earth-shattering in there. It's just a combination of the existing guidance that we have under accounting, the old ASC 470, as well as accounting for government grants. But basically, the funds received are going to be recorded as loans. You're going to accrue interest on them. You're going to you're at a discounted interest rate, but you don't have to impute interest that you may have to do with some other loans that the company receives. And those loans will stay on the books until the company can determine whether or not they are going to, qualify for forgiveness. And at the time the company is able to determine whether it's going to be qualified as forgiveness, they will be able to recognize that forgiveness of the loan as other income. So, pretty straightforward. Most companies, I think, if they determine that they are going to forgive, have the loan forgiven, they're going to show it as a long-term debt item, and then until it's actually forgiven. What's coming down the pipe, we'll see. But it'll be interesting to see. I think this June quarter will be the first time most of these companies have these loans on the books. So we'll see how people account for it. I think the only other thing is in your accounting policies, you really just have to know how you are accounting for the loan.
Right. So thanks, Corey. Along those lines, I've had questions from our clients. Well, like Levine, we want to get this forgiven immediately so we can show income this year. And I've had other people, say, no, we'll apply for forgiveness after December 31 because we don't want to pick up the income until the thing is forgiven. So that's some of the just interesting that I found. Anyway, next question, let's throw it over to Steve. So Steve, during the time of the pandemic, right? So businesses aren't paying some of their expenses. Maybe you want to talk about unplanned rent and other business concessions due to the pandemic, and what is the impact going to be on GAAP?
Sure. If we focus on leases and the reality that both lessees and lessors have been and may be in the middle of trying to determine whether or not they need concessions now or they need concessions in the future, it triggers potential problems under the current guidance. Both the old guidance, which may still be in effect for some companies under 840, and the new guidance under 842, both covering leases, do have what are referred to as modification rules and a rent concession that is provided by the lessor to the lessee outside of what would have been negotiated in the original lease typically would go under those modification provisions. The problem is the modification analysis can be complex, it can be timely, and it's done on a lease by lease scenario. And so what the FASB did is they did step in to provide some relief in this area because that analysis would be done by both lessors and lessees, and so affecting both parties. And as I mentioned, it could affect a number of leases. So FASB has offered up an election to allow companies to account for those concessions as if they were negotiated in the leases at inception, which the results of that election will give companies a simpler, less timely, and hopefully less costly path forward in dealing with those concessions, as opposed to going through what's considered the complex modification analysis. The thing to keep in mind for companies, in order to qualify for that election, they do need to conclude that the concession was both A, related to COVID-19 or its impact, and that B, the sum of the total payments under any concessions would be substantially the same or less than the original contract. And so if those two things are true, then they can apply this election, which provides some relief. If neither, one or both are not true, then unfortunately they'll have to go through the more complex, time-consuming analysis.
Okay, thank you, Steve.
Sure.
More on those lines, David. What happens if a company would need to restructure their debt? And, you know, I've been getting calls, Levine, we didn't make our covenants, you know, do I have to look into the future, especially with these debt covenants? So maybe you want to talk a little about the covenant violations that are occurring and the restructuring due to the pandemic.
Sure. Let me address the restructuring piece first. Anytime you have a debt that's restructured with the same lender, the company that is borrowing that debt needs to consider if it's a troubled debt restructuring. This is important in the accounting world because the accounting for a troubled debt restructuring can be significantly different from the accounting for non-troubled debt restructuring. In order for debt restructuring to be considered, you have to have two things. Basically, the company must be experiencing financial difficulties, and the lender grants some kind of concession. The accounting literature, which is ASC 470 on debt, provides some of those indicators. For example, if the company's in default of the debt, that would indicate that they are in financial difficulties. If there's substantial doubt or significant doubt about the company's ability to continue as a going concern, is also one of those indicators. And that literature then provides guidance on looking at if a concession was granted. If it's not considered a troubled debt restructuring, the company needs to consider whether the restructuring then is a modification or extinguishment of debt. For example, say the lender would charge an extra fee or increase the interest rate in order to change up the debt to accommodate the borrower, then this would not be a concession in and of itself. And you know, during these uncertain times, I think we will see several debts restructured, especially in some of the certain industries that are having more difficulty than others, like the restaurant businesses. Here in Houston, we will probably see some in the energy world because of the oil prices being much lower than the oil companies and the lenders anticipated. But to assess if it's a modification or extinguishment, basically you have to do an analysis of the cash flows. And if the restructured debt differs more than 10%, then it is considered an extinguishment of debt. Otherwise, it's a modification. And then getting to some of the debt covenant issues, if there's a covenant that is broken and the debt was previously considered long-term debt, then if the covenant puts the debt in default, then that debt would then be considered current and not non-current anymore. You can have the lenders provide waivers, but a lot of times lenders will only provide a specific waiver to a specific covenant. So one of the things that the company and we as the auditors have to look at is, are there any other covenants that might be broken within the next 12 months that would then cause that debt to be basically callable because of a different default. And so there's a lot of issues there when it comes to the covenants. If you're a company and you're fortunate enough to get the lender to waive all or most of the covenants, that wouldn't be an issue, then congratulations. But you need to make that assessment. And that's one of the things that we look at as an auditor every period is, have the covenants, any of them been defaulted upon that would cause the debt itself to be in default, which then changes the classification of long-term debt to current.
Thanks, David. That was a great explanation. So I'm going to get off the gap a little bit and lighten this up a little bit. So Ed, yeah, wow. Ed, why don't you just talk about during the pandemic, how your clients, public companies have been dealing with working remotely, how they've been filing timely, and also we're all in business together. I thought we would maybe just talk about, what we're facing as accountants having, our people work remotely. So Ed.
Sure. Thank you, Neil. First and foremost, for our registrant clients, the SEC has come out with some indications of what they want to be hearing and seeing in terms of disclosures. First and foremost, whether it's in your risk factors, the company's footnotes, or in the MD&A, what is the impact of the pandemic? How does it affect the efficiency and effectiveness of the business? In our business, it was more a struggle for the tax people to get used to working remotely, because auditors are used to working, out in the field. Tax people usually work in the office. And so there were some inefficiencies, that came with that. So, realization may have slipped a little bit in terms of the productivity of the team. With our clients, what we're seeing is that, if you have a production facility, manufacturing, it's really difficult to work remotely when the machine's in the factory and you're at home. So you can readily see what kind of a blow that would have. But it's also, admin people have a different function than operations people, than finance, so on and so forth. So when you go through the different elements of a business, different departments or functions are going to operate differently in a remote capacity than not. With our registrant clients, we want to hear from them and help them discern, based on what the current trends are, the current realities are, what kind of liquidity impact is the pandemic having? What are they seeing from their suppliers? What are they seeing from their vendors? Is the time frame of production going to be longer? Is the repayment cycle from their customers going to be longer? That certainly affects working capital and cash flow type situations. If sales are being delayed from Q2 to Q3, it may be net for the year, but quarterly, there's going to be impacts. And so we're helping our clients dig in deeper with their data and their thought processes, taking those two things together to discern what's the efficiency and effectiveness, what kind of changes are they seeing, how long-term or short-term might those be. No, we don't fully know where this pandemic is going and how long it's going to take. And how does a issuer company best inform from its risks, its ability to adapt to that, and to tell their own story in terms of how they're going to navigate these rough waters and how it's going to work to their benefit as even if there's a slight benefit in all of this, what are they doing to make it rosier than bleaker?
Thanks, Ed. So Corey, with all the things we're seeing in the pandemic, the impairment of certain assets, writing the footnote disclosures on liquidity, so talk about the effects in the financials on some of these items. And a question that I was thinking about is, what happens if you impair one of these assets or you impair goodwill just because of the pandemic, and God willing, we get some kind of vaccine and now we're back to normal? You want to just talk about that a little bit?
No, that's a great question. Absolutely, COVID has had a significant effect on the financial statements of companies, impairment of assets, issues relating to recoverability of accounts receivable, realizability of inventories. These are huge issues that companies are facing, and management has to make decisions on these impairments and whether they're going to be able to liquidate their existing inventories, whether or not they're going to make collections from their customers. So inherent in all this is, the management really have to make a conscious effort to make realistic forward-looking projections of their operations to make these decisions. And they not only have to make forward-looking projections of their operations, but also of their customers' operations, because this severely impacts the financial statement presentation. Neil, you ask a good question. If you go through and we do an analysis this quarter and there's an obvious impairment of an asset and you have to take an impairment charge, under US GAAP, those charges are not reversible. IFRS is a little different. I think you're actually able to go back and recover those charges. But it's a very, very significant decision that has to be made. You have limited information. You don't really know what the future is going to hold. But as we all know, working in the public markets, 6 months from now, a year from now, where things change and SEC or shareholders come in, they're going to hold you to these estimates that you make now, despite whatever efforts that you make. So you just got to make sure these estimates are well documented and that your conclusions are well thought out, because there could be repercussions a year down the line when these things kind of sort out and everyone's going to kind of forget what we're dealing with. Also inherent in the preparation of the financial statements is, management has to make a decision relating to whether or not there's substantial doubt about the company continuing business for a year after the financial statements are released. More commonly referred to as going concern. In the last round of filings in the first quarters, we saw a lot of companies, bigger companies, make these going concern disclosures. A lot of them were industry specific. Certainly those in the entertainment industry, certainly those in retail were hit hardest. We saw a lot of those disclosures. And obviously, going concern disclosure, if you're a normal operating company, could have a detrimental effect. For those companies that are in the middle market, the small cap companies, the companies maybe that are at the LD Micro conference, they're more used to having needs for capital. I don't think a going concern opinion is necessarily a death sentence for those companies, because they're kind of usually in need of capital, and I don't think that that's going to upset investors or the market too much. But for some of these bigger companies, you can see it's a major concern. And the onus really falls back on management to make good faith estimates and to be very transparent in their disclosures. I think we're going to be talking soon about the SEC's new release. But it's just all about transparency, and just, it's the elephant in the room, and it needs to be addressed.
Thanks, Corey. So piggybacking off of that, Steve, talking about forward-looking statements and how accurate the company's estimates would be right now on cash flows. When you take this impairment of goodwill or writing down some of the assets, maybe you just want to talk about how we have to handle that going forward, the forward-looking statements.
Sure. And, I'll start out by saying that, I agree with everything, Corey mentioned. Accuracy is, it's always been a challenge under normal circumstances. Estimates are inherently difficult under normal times, and with the pandemic, the impact on the economy, the impact on the world economy, the ability for companies to make those forward-looking cash flow estimates is more challenging now than it's ever been in many cases. Unfortunately, the guidance doesn't provide any relief in these times, and so the challenges companies faced with the accuracy of those estimates, whether it was for long-term assets, whether for goodwill or going concern, the need for accuracy remains, and with the challenge being more difficult than it was previously. And so I think companies are having to not only sharpen the pencil and think about what it is their customers are dealing with, what it is their business looks like, but they're also having to do this maybe more frequently than they would have done it otherwise when, pre-pandemic, pre-economic shutdown times. For many companies, these types of issues may not have been at the same concern as they are now. And so they are facing the need to provide or put together these estimates and needing to do so maybe in unexpected intervals, such as quarters, versus maybe what some companies may typically do it at year end. And so unfortunately, there is no change in what's required under the rules. As Corey mentioned, when we get down the road, there will be regulators and others looking back at some of the decisions that were made. And so it's certainly difficult right now for companies to see into the future, but they are being held to the same level of accuracy and precision as they were held to previously, which certainly, again, can be difficult.
Thanks, Steve. So, David, still focusing on some of this goodwill impairment. So, wow, if you did a quarter or coming up quarter, and if the market cap of a pubco falls below, its book value, do we have to start looking and doing impairment analysis on a quarterly basis, or what's going to trigger this?
Sure. Thanks, Neil. Well, the requirement to do an impairment analysis on goodwill is an annual impairment. And then the further requirement is if things significantly change, typically for the worse, then you may have to do an interim analysis. While the market cap generally reflects what the market believes the cash flows of the company on a discounted basis, if you will, is the goodwill impairment by itself is really just a reporting unit because it was created by the company buying another business unit. And so it's the goodwill on that business unit. And so that impairment assessment is performed if the company has determined that it's more likely than not that the fair value of the reporting unit is less than the carrying amount. When there's a substantial decline in the market cap, the company needs to consider whether the projections that have been used in the past for that analysis of the fair value versus the carrying amount, has that been impacted. A decline in the market cap that could be extremely severe, may trigger a need for a test. It all kind of depends on the facts and circumstances. A good example that I've been involved with recently is one of my oil and gas companies. Yes, the oil price has come down significantly since year end because of the pandemic crisis. However, that particular company has their production hedged for the next couple of years. So they know through the hedge that they will get, X dollars, $50 a barrel, whatever the price is. So it has not really impacted them. So you've got to look at the facts and circumstances of each situation to decide if it's an analysis is triggered, the need for an analysis is triggered, during an interim period.
Thanks, David. And so let's go to Ed. Ed, sometime around June 23rd, I saw that the SEC came out a month ago and they were talking about topic 9 and topic 9A with specific COVID disclosures, and I thought you might want to just add something to that.
Yeah, sure. Thank you, Neil. So the Corp Fin came out, like you said, on June 23rd with updated guidance in topic 9A. So earlier this spring, mid-March, I think they came out with topic 9, and they're diving deeper and deeper into what kind of issues should the companies be disclosing and in what form should they be disclosing them. So it's raised the bar for the issuers in terms of how they discuss the impact of COVID to the markets, to their investors, so on and so forth. So in that, what are the types of operational issues that management and the board are grappling with? Does it relate to liquidity, revenue recognition, the timing of when revenue comes in, supply chain, various, are they renegotiating contracts with either customers or with vendors? What kind of impact does that have on items such as liquidity, cash flow, and so on and so forth? In addition, our clients also need to be looking at what do the capital market resources look like for them? Are their traditional resources still available? Do they have borrowing capacity, or are they maxed out in borrowing capacity? What is their burn rate? Do they have sufficient cash flow for a year and a day from the date that the financial statement is issued? Otherwise, there's a going concern question there. How do they look at funding sources? Are those funding sources looking to invest, or are they wary of putting additional monies into the market today? These are all questions that issuers need to be able to answer and disclose within risk factors, their footnotes, and in their MD&As. Lastly, what changes have there been to management's estimates and assumptions? I think that it would be a little disingenuous for someone to say none of our estimates or assumptions have changed since the pandemic arose. most companies have had some impact. Usually it's a negative impact, and how does that transform into the results of operations and the financial condition? We have some clients that fortunately are doing very well in the pandemic. They're SaaS businesses or other types of businesses that have had ongoing business, good collectability on receivables, and have had lesser impact from the pandemic. And they also need to be able to discuss why that is, and can that continue, or do they expect to see that falling off? So that's kind of the layout as we've seen it from our client base.
Thanks, Ed. And on the lines of new pronouncements beside 9 and 9A, Corey, this is for you. What about management's assertions on either disclosures or the new regs regarding critical audit matters that management needs to get into?
Yeah, it's going to be interesting this year. On the audit side, the PCAOB has put out a new standard that changes the format of the auditor's report, which will become effective for most of the small business filers as of December 31st, 2020. So gone will be the old report that was 3 or 4 paragraphs long and basically was just the standard, unqualified opinion. Now the auditor's report is going to be changed substantially based upon the guidance adopted by the PCAOB early, a few years ago, which the accelerated filers pretty much have been using for the last year. But in that auditor's report, the auditors are going to have to be responsible for commenting on what's called critical audit matters, or CAMs. And these are matters that are especially challenging, especially complex, and really involve a high degree of subjective auditor judgment, and estimates, testing of management's estimates and assumptions in making these decisions by management, and whether impairments, things like impairments, are needed. The first year or so of audit reports are out, and most companies have at least 1 to 2 critical audit matters. The PCAOB has said it'd be very unlikely for a company to not have a critical audit matter. And as expected, most of the critical audit matters really relate to goodwill and testing of long-term assets and impairment, deferred taxes, which again are subjective to estimates and assumptions. Revenue recognition, lots of times, for instance, like Microsoft, they have to bifurcate the revenue into different revenue streams based upon the contract. Contingencies, obviously, there's a lot of estimates in there. But I think the one that's going to be even more interesting this year is going to be on going concern, and how the auditors evaluated going concern. There are 2 requirements for going concern. Management makes their own assessment and going concern and liquidity and puts it in their footnotes, and then the auditors are responsible for issuing an opinion and whether or not they are going to comment, modify the report for going concern uncertainty. So I think what we may see this year is companies in their financial statements talking about liquidity, but not necessarily saying that there's a going concern. And then the auditors in their audit report talking about how going concern was a critical audit matter, but then they ultimately decided that there wasn't a going concern. Now, I think if you go back and look at some of the actual past filings, there are a couple of those. So I think that'll be interesting. I don't know if a company is going to appreciate that, saying that we considered whether or not there was a going concern, even though there wasn't. So it'll be interesting, but definitely the effect of CAM will, and combined with the COVID, is going to have a significant effect on the auditing this year. And really, what's going to happen is the auditors and the audit committees and management are really going to have to start addressing these, assuming your December year end, should be addressing these matters now.
Thanks, Corey. Thanks a lot. So I want to change focus a little bit. And I know that the December 31 public Form 10Ks have been delayed. And Steve, have you heard of anything else coming down the pike for other relief, whether this time's Qs coming around, which are, I guess, due August 10th to the 15th? Anything going on with delayed IPOs, or what's happening out there?
Sure. All good questions. As far as the relief, as you mentioned, the 10Ks for December 31, 2019, as well as any filings, whether 10K, 10Q, or 8K that was originally due by July 1st, all received an extension of time, and many companies did take advantage of that COVID extension, which provided basically another 45 calendar days. At this point, further relief is ultimately unknown, although I think it's generally not expected. Although if the company were to experience another total shutdown similar to what occurred in, say, March and April of this year, I think it would be possible. SEC would reconsider providing more time for future filings. As you mentioned, the June filings, which are due in August, currently do not have any additional extension or relief related to COVID, and it's unlikely more time would be provided. I think that the SEC's view is at this point, the companies, their service providers, whether on the legal, accounting, or audit side, have all adjusted to the new normal and can now, whether they're working remotely or back in their offices, accommodate filings under the normal timelines. So again, if something dramatic were to happen in the coming weeks or months, we could certainly see potential additional relief, although right now it's not expected. As far as IPOs go, our observations on IPOs have been mixed in that, some continued as planned with maybe some slight delays if their timing was originally March or April, just allowing for everyone to kind of get adjusted. Some have been long-term delayed, and others have been, altogether sidelined. And I think the observations in those areas are really specific to the companies, maybe where they were in that IPO process when the pandemic started to impact the markets, as well as the industries that they are in. Certain industries are considered maybe more attention being on them for fast tracking an IPO versus other industries. The timing, may not be perfect now and are certainly delayed until circumstances change.
Thanks, Steve. So throwing it back to David, we spoke a little bit in the first question, and we're kind of running out of time now, but I know there are PPP loans out there. I know there is some money that it's still available, and we keep hearing about another stimulus, and nobody has the crystal ball. But regarding the government assistance, just maybe give our viewers a little bit about the gap that you're going to have to take into consideration.
Sure. We touched on it earlier, as you mentioned. Unfortunately, there's not a whole lot of direct accounting guidance when we talk about government assistance to business entities. There is some guidance for the not-for-profit entities, but not for business entities. And so you have to look at other guidance. There is some guidance on the international accounting standards that we look to. And then in June, I think as Corey mentioned earlier, the AICPA came out with some guidance in a technical question and answer document that kind of addresses the accounting for the forgivable PPP loans. The SEC staff also shared its views, indicating that it would not object to an SEC registrar on accounting for the PPP loan under topic 407, which is the debt accounting literature, or as a government grant using the analogy to the International Accounting Standards accounting. What I find interesting here is that the guidance from the AICPA allows a company to record the forgiveness once there is reasonable assurance that conditions have been met that forgiveness will occur, which is a little bit different than what I'll call the old accounting, in that you couldn't record forgiveness until the lender actually did forgiveness. So I think that's going to be something that's a little bit different. And I think, Neil, you had mentioned earlier that you've got one client that wants to do it now and another client that wants to do it later. I think the guidance that the AICPA has put out there allows a lot of flexibility as to the timing of that income. And, you know, one of the things, you know, when I put my auditor hat on is when is reasonable assurance, when are those conditions met? And so I think that'll be a challenge with some of the clients, companies that want to be maybe a little bit more aggressive and try to record income before they actually get the formal forgiveness from the SBA. You know, like we mentioned earlier also, you know, you got to stay tuned because things are likely to change again. We're going to have another stimulus package. Will they change up the PPP program again? Only time will tell.
Great, David. So I want to get this question in for Ed. I got a text message today that said, U.S. economy shrinks 32.9% for the last quarter. And, you know, I don't know if you can believe whatever, it's breaking NBC News, but I would ask you, where's your crystal ball and what's going to happen in the next 6 months?
That's a softball if there ever was one, Neil. You know, I don't necessarily hold the magic here, but what I will say is for the viewers and participants in the conference, you know, what's key here is what is your next normal? Whether it's what it's been for the last 3 months, you know, Q2 is going to be a great window for us to look through and see what we can learn from what happened in Q2 and what impact will that have on Q3 and the remainder of the year. If everything stayed steady with Q2, what does that look like for our clients? With that, if they are going to find pockets for growth, what are the most opportunistic things? What do they do best? How are they going to distinguish themselves? And then how are they going to bring that message out to the public?
Great. Thanks, Ed. So with that being said, unfortunately, I have another 50 questions, but the head of this thing, Robert Kraft, says, Levine, we're done. So with that said, I'm going to throw it again to each of my panelists on where they can get information about their firm. My website is www.friedmanllp.com. And with that, I'll sign off and throw it to Mr. Grossman.
Thank you, sir. And I, again, am the assurance partner in charge of the Houston office for Marcum. And our website is www.marcumllp.com.
Thanks, David. Corey, how are you?
Fine. Thank you, Neil. Corey Fischer, managing partner, Weinberg and Company here in Los Angeles. WeinbergLA.com, WEINBERGLA.com. Thank you, Neil.
Thanks, Corey. Stephen.
Thanks, Neil. Thanks for moderating. I'm Stephen Vertucci, a partner in the Houston office. The website is www.malonebailey.com.
Thank you. And finally, Edward.
Yes, sir. Our website is www.SingerLewak.com. That's SingerLewak. Thanks very much, Neil.
Great. So hopefully I'll be able to see everybody in person and give you all a big hug at our next conference, which we don't know the date yet. But Robert, are you around or no?
Oh, I'm right here. Yeah, no, we're around, we're always around, we're only a Zoom call away, Neil, you know that. But I want to thank everyone here for participating today. Neil, as always, great moderating, everyone, a lot of great information in there. I hope everybody was able to take a few things from what was said today and, follow up with any of the gentlemen here with more questions and more information. I'm sure they'd be happy to help. So with that, thank you all, and see you soon.
Take care.
Take care, everyone.